After about a year's job, Shreya Bijlani now has enough money to invest. Shreya read up a bit about mutual funds and found out that Systematic Investment Plan or SIP is an investment plan in which one can invest every month, and it's a great investment option. While Shreya does not understand the nuances of stocks or mutual funds, but seeing the returns of the SIPs, one of her friends convinced her that both savings and returns can increase when one invests in a SIP. However, investing in SIPs is not as easy as it sounds. It's confusing, to say the least. It's a big mess. After all, why don't all mutual funds give the same return? Everyone buys stock from the same market. The rules of operations are also the same for everyone. Then why is it that there is so much difference in the returns of the large and mid-cap funds for 1, 2 or 3 years? Well, large cap refers to the large cap stocks, while the mid cap refers to the medium stocks. Mutual funds are good. They are the right investment. Every household must invest in a SIP. It is easier than ordering food online. Return on the mutual funds or return on investment is, however, determined by many complex factors. The co-founder of Wisdom, Anand Dalmia, says different fund managers apply their own investment formula in the same type of mutual fund. This is why returns also differ. There could be 3 reasons why the other mutual fund can be better than yours. First reason is that fund managers also make mistakes. The decisions of fund managers are based on many economic and technical reasons. If their choices are not right, the second reason could be that portfolio manager or your fund manager also balances risks with return. And because of this, sometimes all the stocks in the portfolio do not give the same return, due to which the profit from the entire fund remains less than the other competitors. Amit Gupta, MD SAG Infotech, has said that the risk management is one of the major reasons why some stocks are weak and some stocks are good in a fund, and hence the returns are not uniform. The third reason could be that your fund may be weaker than others because the fund manager is spending more money on management, or when you are selling the fund, he's charging you more money. That is the management fee, which is called exit load of the fund. Harshad Chetanwala, co-founder of My Wealth Growth, has said that a fund manager always tries to give maximum profit by keeping the risk limited. No one wants investors to lose, but a fund's performance varies due to various factors. Sometimes timing puts fund managers in trouble. You must have heard the bad news about Franklin Templeton. In April of 2020, the trustees of this fund closed their 6 yield-oriented funds. After the lockdown, companies faced a big cash crunch. Their money was invested in this fund and there was a rush to withdraw money, leading to the collapse of the funds. 6 schemes had to be closed. Many investors are still even waiting to get their money back. We started with Shreya's confusion and came to Franklin. Now that it is known that not all mutual funds are perfect, why do they all not have the same return, and how should Shreya finally choose their fund? You should choose a fund based on your investment goals. That is, how much do you want to invest and for how long? Like investment in debt funds can be made for a long period. But if it is an equity or an index fund, then the fund manager's mistake can hurt your investment. Do obtain adequate information on the investment strategy of the mutual fund that is being offered to you. At least check the portfolio of the mutual fund. It is imperative to know whether other funds like it have performed well in the market or not. Now, if you want to invest in equity mutual funds, then meet our Formula Guru.